Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 39. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting in his Dutch orange shirt here. And we've got Keith Dicker with IceCap Asset Management in the John Deere tractor. I think Keith just got a brand new tractor for to mow his mansion there. He was sending pictures, tarps off, pounding beers on the John Deere tractor there. And I apologize in advance. I violated my own rule. I did not bring my mic. I am away. I'm in Penticton right now, so getting married in the next couple of days here when this podcast probably drops. And I forgot my mic, so I apologize in advance. Power through it. What's going on, Rich? Rich is back from Iceland, the Love Boat.
Yeah, it was really cool. Definitely recommend going to Reykjavik. It was amazing. Really lovely people, great bar, like coffee scene, and without the hipsters. It was just a really, really wonderful culture and just like a really great history. I mean, these people have suffered and have really made the most of it. So it's, I don't know, for people who may not know, it's basically the last vestige of the Viking sort of culture and language. These people, it was farmers, not seafaring people, as you might have guessed. It was farmers that sort of found this island and immigrated there in the 930 around. And they let their sheep mow down all the trees. So when you go there, there's no trees, and you ask why, and it's because they burnt them down and they let their sheep get at them. But that creates a wonderful, wonderful paysage. There are lava flows, and there's glaciers that are there. I'm a nerd and I like engineering stuff. So there's like geothermal energy that powers all of Reykjavik, which is really cool. And like I said, the people and the beer are great. So I had a really, really nice time.
Yeah. So we're going to get into energy policy here a little bit here today and suffering as well, because I think they kind of go hand in hand. But Keith, what's going on?
Oh, yeah. I do not have a tractor, by the way, but I think we'll talk a little for those that are not watching the video version. Rich and I think we'll be talking a little bit today about what's happening over in Europe, which continues to, I guess, Rich, and Steve, is the overlaid theme that we've been talking about for quite some time now. One with regards to Europe, and the other one with what's happening with the energy sector and policies that are being implemented. But I think we also have a Twinkie bet we need to get established in today's episode as well. And, there's a whole bunch of stuff. Has the recession started, or has it ended already? That thing came at us fast. So we got a good week today. This is going to be a good chat today.
It's going to be a good podcast. And like, to remind everybody, like, when, we talk about, there's going to be some people that are listening to this and go, Europe again. Just understand that everything that we talk about ultimately comes back and does correlate, domestically here in Canada, for our Canadian listeners. So, kind of bear with us as we travel the globe here, but let's start it off domestically, which is, we got the Bank of Canada coming up, I believe next week, July 13th. So July 13th, guys, mark that on your calendars. That's going to be a fantastic day, because you've got the Bank of Canada coming out. You've got, I think, US CPI gets released that day as well, which everybody's eagerly anticipating. And I believe NHL free agency also begins late this year on July 13th. So
the most important one of those.
If you're Canadian, that is a very important day. So July 13th, mark that on your calendars. But as of right now, the Bank of Canada, I believe market expectations haven't really changed much. It looks like 75 basis points is basically chalked up and ready to go. does anyone want to take a bet on 100 basis points or 50 basis points, or I'm sticking to 75. I'm not going to fight the market on this one. I think the central banker has been pretty clear about their course here, to my surprise.
Well, I think I established 75 a couple episodes ago. So that hasn't changed. However, one thing that I think could be happening by the September or October meeting, I think they could be done by then. And that's an enormous move that happens. Because right now the market's expecting 75 next week, and then for September another 50 and whispers of 75, then another 50 in October. I think it's no longer a 0% chance, but it's now increasing. The probability is increasing that if we start to see economic data rolling on, which I think it could happen, you could see the Bank of Canada just either stop hiking or become a lot less hawkish than they were. And that's a big contrarian call. I see Rich is grinning now ear to ear. But
I think I'm just going to go ahead and do it. I'm going to pound my chest. I don't actually have a view on this, but for the sake of entertainment and for the sake of my sugar intake, I'll say I think they will revert back to being the let's just say they'll revert back to form. I'm being polite, and they'll only raise 50 basis points. So there you go, boys. I'm putting myself on the line.
Thank God.
Let the comment
to show up.
The reason I said that, the reason I think that's true is because, again, I will maintain that I think that inflation, God willing, they've maybe paid attention to our podcast and followed me on Twitter and noticed my points about inflation. But also, I think, one of the things is the IVPMI came out. I can't remember the exact number. It came out either today or yesterday. And it was lower than expected, and it's starting to roll over. They're obviously cognizant of what's going on globally. We're going to get to the Europe and stuff, but the US PMI ticked lower again. There's something, whether you think it's a recession or you think it's a mid-cycle slowdown or whatever, clearly the world is creaking. And I think, and I think that, and most importantly, which Steve will elaborate on, is the housing market is starting to shit itself. And we all know the most important sector in the economy is starting to wobble a little bit. And the Central Bank of Canada, his only job is to sustain this housing market. And so there you go.
Yeah, I wouldn't mind touching on that, Keith. I don't know if you want to chime in quickly. I know you were kind of chomping at the bit. Housing after.
Yeah, Rich's point is well taken, and that could be the case because whereas the Fed, whatever the Fed has sold to the market, that they've always delivered. There's never been a shock with the Fed because they always leak what they're going to do, and then they do it. Because the Fed is not allowed to surprise anyone. The Bank of Canada is not very good at it. Either they intentionally try to do it, or they're just unaware of how the world works. But remember a few meetings back, they were, I think it was the first hike, we were expecting 25 and they did 0. Remember that was a huge, that Rich, you won the bet that time. That was the first Twinkie bet. Yeah, absolutely. So this time, again, the market is clearly communicating to the Bank of Canada, hey, you've now guided us to 75. That's what you should do. But there is, as I was trying to explain, there is now evidence or support coming out where they could become less aggressive. So maybe instead of 75 this meeting and 50 next meeting, maybe they do 50 this time and 20. I don't know. Like they do have the opportunity to do that. However, if they do not raise rates by 75 basis points next week, I think Canadian dollar would just go in the crapper next week. Like it'll come down. Because the other thing to remember as well, as Steve made a good point earlier, the whole world is connected here. And if you align what rate expectations are for the Bank of Canada and the Americans, they're lucky. They're right in line from July, September, October/November, and December for year end. They are identical right now. So, some people say that Bank of Canada, they get their marching orders from the Fed. They get a pretty good phone call. I know that. So if they tend to deviate from this, then, we will see the market reaction. But I'm in for 75. That's what I go with. Rich is in for 50. What's Steve going to do?
75. I'm boring.
Do I have to eat 2 Twinkies if I get this wrong?
Only if you want.
Okay.
But yeah, I mean, on the housing front, yeah, I mean, kind of as I've talked about before, right? When we talked about rate hikes at the beginning of the year, the thesis has always been, listen, yes, you can, of course, you can always raise interest rates. You can raise them as much as you want, but not without, a significant amount of pain. I just don't think that the system is really built for that. And especially here in Canada, we're seeing all these rate hike increases, and look what's happening to, housing, which is really like our economy. So the greater Toronto area, back-to-back months of 20-year low in home sales. Now, again, keep in mind that when you look at like the GTA, that's Canada's largest major metro. It is our most important, I would say, province from an economic perspective, from a housing perspective. When regulators set policy on a federal level, a lot of that is with the intention of Ontario. And so the bull thesis for like Toronto housing has always been like record population growth. Everybody's moving here. Like we're like the next Manhattan, like that. Like that's what people say in Toronto. And so when you say, well, you've got a 20-year low in home sales, that's not adjusting for like the population growth of the last 20 years. That's not adjusting for the increase in housing stock over the last 20 years. So like, this is a collapse in housing activity. And that's for 2 consecutive months. We're seeing parts of that in Vancouver. Here in the suburbs, we had a 20+ year low in the Fraser Valley. You are seeing prices coming off. They're not necessarily being captured by home price index or benchmark prices because those are lagging indicators, which I think is ultimately what the Bank of Canada actually relies on. So they're kind of forward. They're not forward thinking. They're backwards looking. The central bankers are using, I would say, stale inventory. And Rich, I mean, it's probably the same thing as, CPI, right? I mean, CPI is arguably a lagging indicator. So I would imagine that, these guys, again, are not, I'm not sure how forward looking they are. So I think they are obviously hiking into that slowdown. It's interesting. I was actually chatting with one of my friends. He runs a pretty large research firm in Canada. And so he was telling me that they interviewed former Bank of Canada Governor Stephen Poloz last week, kind of getting some of his thoughts on the markets and so, I mean, the takeaway from that was basically, Poloz was like, yeah, I wouldn't want to be a central banker today. He wouldn't comment on what he would do if he was Tiff Macklem. He says there's an unwritten rule in central banking that they're not allowed to sort of comment on that. But his view was ultimately that they're going to raise interest rates again. I mean, pretty obvious, very aggressively in the near short term. But he was of the opinion that rates will be coming back down over the sort of medium to long term, given the amount of debt and sort of demographics and whatnot in most of the world. So, yeah, I don't know. It'll be interesting. Obviously, I mean, Poloz was talking about housing. He definitely thinks it's going to adjust. He's like, as it should, right? I mean, housing is all about interest rates. And yeah, I mean, I wouldn't mind chatting as well on the bond market, what you guys are seeing there, how you're viewing it, because when we talk about Canada anyways, we always look at the Canada 5-year bond that had a huge rip over the last 3-4 months. Everyone's talking about rates hitting 5%, going to 6, 7, 8%, and the world collapsing. And over the last 2 weeks, we've seen that Canada 5-year bond yield drop by about 50 basis points, which is a huge move. And we've seen some of the big banks now actually cutting their fixed rate mortgages ever so slightly. So we're seeing a little bit of easing on the fixed rate mortgage side, and then another bounce back up over the last day or two. So a lot of volatility in the bond market. Rich, I don't know if you're watching that, but these do not seem like very normal moves. I mean, it seems like there's a lot going on in the rates markets.
I mean, I don't know. Normal is a bit tough. I think when you get to really, really low levels, I think that, like we've talked about before, there's a leverage issue that I think sort of kind of messes around with that. So I can't speak to normal, but I do know the bond volatility index, which we discussed here before, the MOVE index. You guys can Google it if you want. Its corollary is the VIX, which is the VIX CBOE VIX volatility index. It remains super high. I mean, so there's something going on. We've talked about, but the funny thing is, just to remind some of our listeners, when bond yields go down, prices go up. And so, and forgive me if that's obvious, but so just important to note that some of the best performing assets over the last, let's say 2 weeks or whatever, have been bonds actually, which makes sense. Month to date, the German Bund is up 2%. I mean, that's quite a lot. Again, bouncing from massive lows. Hey, I get it, but
sorry, we didn't drop. We don't give investment advice in the show, but I think we did talk about getting long TLT like what, 3-4 weeks ago.
Yeah, we actually nailed that. I mean, we've gotten a bunch of things wrong, but that one we absolutely nailed. So I was quite happy with that. I think it's we talked about different reasons why that might be happening. Keith's point has always been about weaker growth. My point has been more on the valuation front. And also, maybe on the inflation bit, but I mean, I think it's never just one thing. Let's be very, very clear about that. It just never is. The other thing that I think people should pay attention to is, again, credit spreads. So credit had an okay, after giving up and after losing a lot of money over the last little while, credit and let's say non-government bonds. So investment grade and high yield corporate bonds also had a decent couple of weeks. But again, this is after giving up 20, in some cases 30%, right? So is it a dead cat bounce? Who knows? But that's sort of how that's worked out.
Keith, how are you looking at things?
So the movement in rates over the last couple of weeks, in our view, it's because we have this transition taking place now between, we're in this hyperinflationary environment to all of a sudden we could be going into recession. So that's why we're now all of a sudden everyone who was short, treasuries and federal government bonds, and they made a lot of money by shorting that market. And, every other Canadian in the balance fund lost money, with that kind of strategy. Money is now starting to flow into long government bonds, and they're trying to figure that out. And so I know here in the podcast, we introduced a concept a few weeks ago that, hey, the probability of recession is now no longer zero, it's increasing. And now seems like every hour there are new headlines coming out that we're headed for a recession. So in my mind, that's what's driving the bond market right now. And so for us, I always say at we're always looking for an opportunity coming up. And we think now there might be an opportunity in the government bond market. It wouldn't be one of these long-term trades. It's more of a shorter term allocation, and we'll see how it goes. I suspect what will happen, because remember, the world is always in extremes right now. It's never this sort of Goldilocks environment because things have been, pushed too far. But I suspect we're going to go into a period where recession expectations will hit 100%. GDP estimates are going to the arse will drop out of it, as they say, and stuff like that. And then that's at the point where bond prices may have rallied at the most. So the 10-year, for example, will go from a 3% yield maybe down to a 2%. We could get that movement here. So as Rich said, when rates go from 3% down to 2% for a long-term bond, you're probably going to make 10% on your money. That's the kind of opportunity that some of these managers are looking at. But to give you an example right now, so this morning RBC came out, and by the way, you always got to be wary of the biggest guy out there when they announce something. But they said today that they're expecting the Canadian economy to hit a mild recession in Q2 and Q3 of next year. So it's pretty significant because the banks have now, they're starting to transition away from stable growth. They've gone from accelerating growth to stable now. Yeah, we think things might get soft a year from now. And what I'm pretty sure of is that you're going to see this number get adjusted down and pulled forward. So right now they're expecting a 0.5% decline in economic activity during Q2 and Q3 of next year. And what I suggest is, come September, that number is going to be pulled into Q1 of next year. And they'll all of a sudden it's going to be 1.5 or 2. Because remember, nothing ever goes from, bang to bang right away. It's these gradual movements, and that's what everyone has to be wary about right now. So so all of a sudden, if we are heading into recession, everyone's talking about it. It's going to create the opportunity. Then everyone's saying, hey, when will central banks stop hiking rates? And the one story and narrative that I'm hearing out of the US, out of the Fed, as well as the Treasury, is that they're not going to stop. They want to crush the economies and currencies of some specific players out there around the world. So maybe we may not get that central bank reaction to it. But again, there's a lot of things happening right now. And so hold on to your hats. Oh, I forgot my hat. We'll put the hat on for the next. I
got a question
narrative.
for you, actually. So if you're RBC and you're making that public prediction, right? I'm reading it here on Bloomberg right now. RBC is first bank to predict Canada headed for recession in 2023. Is that something where they then like automatically, when you make that call, that they have to then start like slowly adjusting for like loan loss provisions and stuff?
Yeah, absolutely, Steve.
Oh, really? You think so? I thought they had like a Chinese wall between the two, like the research strategy outfit and then the bank lending outfit. I am very naive, aren't I?
No, I mean, so it's a research department. It's a Chinese wall. I mean, that's the term they use in the investment banking world. So like if we're one of the big banks and I'm investment banking and, company, I'm going to bring XYZ to market to do something really cool. I cannot communicate that to the both of you, right? However, it happens anyway, right? That's just the way the world works. This is simply the research side of RBC. So they're not doing any kind of investment banking. They're just saying, this is what we expect the economy is going to do. And all the Canadian banks, they're just stuffed, to the gills. For everyone in the prairies in Alberta, gills is the fish, right? That's where they get their oxygen coming through. Anyway, Steve, because remember we said last quarter RBC had a negative charge for loan provisions, and we said last week on the podcast, hey, you're going to have to start watching what the commercial banks are going to do with that. So I suspect you'll start to see RBC especially start ramping up their provisions again.
It's funny. I'm actually sitting here on the Bloom tubes, and one of the ones that's flashing across my screen, it says on their homepage, U.S. mortgage rates plunged to 5.3% in biggest drop since 2008. So yeah, you're seeing again some of the rates adjusting after a huge move up. In mortgage rates in both Canada and the U.S. now seeing a bit of a.
Can I just interject there for a sec? So I think you obviously you're sharing the fact. I think it's important, but it's also important to just give you sort of an insight a little bit into like why someone like me might make it more of an emphasis on like a moving average in a time like this, when you have a significant amount of volatility. Some of these data points individually, I think they might overstate, let's say, the bearishness or positiveness or whatever. So, because just a couple of weeks ago, we were at 5.98 on that US 30-year mortgage rate, and now we're at 5.3, and that's just 1 month, and so sometimes it's good to sort of step back, contextualize it, throw on a 3-month moving average or whatever, and say, okay, what's the central tendency? And is that central tendency going up or down? And so, sorry, I just thought that I could share a little bit.
I mean, I think the main takeaway here, guys, is basically that the rates markets are basically yo-yoing between inflation and recession, and everybody's trying to figure out
exactly
how this is going to play out. So anyone that has, 100% conviction on, where rates are going or where the stock market's going to be or where house prices are going to be in 6 or 12 months, I think you should run in the other direction, because everybody's trying to figure this out. But, everyone's making their bets and trying to use a probability adjusted, view of where they think things are going and sort of trying to hedge accordingly. But, I think that's just the one thing is I noticed like on Twitter is like, everyone is always like planning for like doomsday and the world to burn. And like, I think that's just like the natural pessimism or cynicism that people have. Right.
But it catches eyeballs. Yeah. But
one
more thing though, guys. Rich. So
go for it.
Yeah. But people should appreciate right now at all the banks and lending institutions around the world, they're really concerned right now. They're doing a pretty quick pivot, and it's always the company that's able to pivot quickly and immediately, get ahead of everyone else, who can either make more money elsewhere or have less losses, and then they can use that to get market share elsewhere. So, for example, like Brookfield Asset Management, like they're one of the most famous companies around the world that can pivot on a dime. Like these things are like the Borg initiative. When something changes, they will, do that. The big banks can't. It will take them a while. So I can assure you, every day now, these guys on the treasury departments and in the risk departments at the banks, they're sitting down and saying, oh, wow, the Loonie Hour guys, they introduced this idea a month ago, and now here we are seeing it happen in real time. But, you could, even though rates could come down, it doesn't mean credit spreads will come down.
Right.
And
that's something I missed on my bit. I missed that when we were talking about the bonds. The credit spreads have not come down.
Yeah. And that's a sign of a recession coming along. Yeah. But anyway, that's where we are. What's happening with the whole food industry these days, guys?
Well, no, I want to chat quickly before we pivot there, because I think that's kind of the next segment of the pod here. But Keith, I just want to get your updated view, because this is going to tie into the food issues and whatnot, and food and energy and inflation. This is all going to come together. We're going to put all the pieces together for you guys. But I kind of want to get your updated views, Keith, before we jump into that, on the US dollar. I know you're long. I know you've been bullish. And we've seen obviously a big move, and that really ties into everything. So can you kind of update the listeners on what's happening with the US dollar and kind of the outlook there, and then we'll transition accordingly.
Yeah, you're right, Steve. The dollar it's either the cause of everything moving in one direction, or it's the result of everything moving in one direction. And it's a little bit of both. We've been on the right side of the US dollar side for a while now. And the dollar is strong because everything else looks so weak. So then you want to look at, okay, everything that's so weak, is there an opportunity for it to look less weak? Again, can it do a pivot or just simply slow down? And then that will cause a lot of money to flow out of the dollar. And what we're seeing right now, like Europe it's on the ropes. Like I suspect right now, as we're doing this on Thursday afternoon, Euro's at 102. I think by Tuesday, we could be breaking the buck on euro. Like it could even happen by tomorrow afternoon. It's incredibly weak. And if that happens, it'll drive more money into the dollar. It'll affect equity markets and commodity markets and so forth. But for everyone investing around the world today, you need to start and end with your view on what's going to happen with the dollar. And if you get that right, it's going to help you either make money or, save money.
So just to clarify, you're calling for parity between the euro and the US dollar.
Yeah, our long-term view for euro is zero.
Yeah.
Wah, wah, wah.
Wah, wah, wah.
So we basically have this situation, guys, just to kind of frame things up here. And as we've been talking about on the podcast for many, many months, is all these things are colliding. And the pandemic was kind of like that trigger, right? There was that crisis that triggered things. And, we always knew there was these fundamental issues. So you have a situation where you've got inflation ripping, central banks trying to fight inflation. And so things are starting to break by raising interest rates. Capital is flowing into the US dollar as that sort of safe haven. We've got horrible energy policy around the world. And again, keep in mind that as the US dollar rises, this puts a lot of strain on these emerging markets who are already dealing with issues from, again, inflation, food shortages. And so while we have it pretty good here in Canada, there is a mess happening across many of these markets. And one of those ones, Rich, I don't know if you want to sort of take the wheel here, is the Dutch. And do you want to just kind of update the listeners maybe that aren't following along? with what's
Sure.
going on there. And this
So, I
is
mean,
all correlated, guys. This is all the same. A lot of this is sort of woke politics at the wrong time.
I mean, so I think like woke gets a bad name. So I think and I think people sort of get riled by that. So maybe I'll just refine it by saying climate change is becoming macroeconomic policy, and in a way that I don't think people have been properly informed about those decisions. I think that those decisions have been made in haste, and they've become, as a result of those decisions being made at a very high level and being pushed down. You can see whether it's Christina Freeland a couple of days ago talking about how we need even more renewables to deal with high prices in oil. There's a lot of political capital that has been invested in this narrow focus. Remember, no one wants nuclear hydro. So it's not that we're against climate change policy and reducing emissions. It's just the narrow focus. Let's be very clear about that. And it's the narrow way in which these goals are going to be met. And so there's a lot of capital. And so again, why do I set this up this way? Because one of the most important data points, before we get to Dutch, one of the most important data points that came out last week was the German trade deficit hit its lowest level. To be clear about this, it's in non-annualized terms. And that's important because it's a 12-month, it's a 12-month series. But anyways, since 1991. So that's an incredible. So Germany, which is normally a global exporting powerhouse, had its visible trade balance. So goods, not including services, but goods, hit basically a 30-year low. And why did it hit a 30-year low? It's because it's importing an incredible amount of natural gas. Natural gas prices have also gone high through the roof. They've gone up 6 or 7 times. So anyway, so that's all related to the next story and what's going on. I don't know. People are not talking about it in mainstream media. I don't want to be one of those guys, but this one is definitely true. There's just no talk of what's going on in the Netherlands. And what's been going on is that there's a massive farmers protest that makes the Freedom Convoy look like, summer camp in Laurentians. To give you some, and so what they're doing is the farmers in Netherlands have basically been told to cut emissions, very specifically nitrous oxide and ammonia by 50% by 2030. So basically 7 years from now. Effectively, what that will do is, in some cases, completely destroy farming businesses, especially in the cattle livestock business. And the farmers in the Netherlands are not happy about this. They're blocking highways, airports. In one video, I saw them basically dump like hundreds and hundreds and hundreds of kilos of manure in front of a city hall building, which is kind of bad because, those people are just trying to do their job, but also really funny. Also, it's spread to fishermen. So fishermen are blocking major marinas and ports in the Netherlands. There's been, and by the way, it's been almost totally peaceful. Let's be very clear about this. This is civil disobedience. This is not violent. These are not violent protests. I'm sure if they were, we would have been, they would have been splattered all over the internet by now. But anyways, and so the reason is, and I think another thing that's really important to know about these Dutch farmers is, these aren't people who are taking kind of unsubstantiated these are not knuckle draggers. These people care about climate change. And you say, "Hey, Rich, how can you be so sure about it?" Netherlands has one of the most sophisticated farming apparatuses in the world. It punches way above its weight in terms of food export, efficiency, output, quality. It spends an incredible amount of money on research and development. It has an incredible amount of greenhouse gas. They reuse their fertilizers. It's extremely efficient. And then there's loads and loads of articles by places like National Geographic or the WEF from a couple of years ago that's talk about how Netherlands is a model for sustainable farming in the world. Okay. So these guys are not knuckle draggers who don't give a shit about climate change. These are people who have committed to being an extremely efficient producer of goods and have basically been told they're not allowed to have cows anymore. And they're not having it. And this is why we talk about this, is because it relates to obviously the German trade balance going almost negative for the first time in 30 years, right? Again, no nuclear, only wind. And it also relates to a really, really sad story, which is the collapse of the Sri Lankan economy. You say, Rich, how can those two be related? Well, 2 years ago, in their infinite wisdom, the Sri Lankan government said they don't want to use any artificial fertilizers. Again, this is, see how it's all sort of connected. And again, it's the same sort of artificial fertilizers that the Dutch are using, which cause, yes, are emission heavy, but are very, very good at growing food. Sri Lankan economy is, and I quote the prime minister, has collapsed because they went organic and their crop yields basically are a fraction of what they should be. So anyways, so this is sort of this is the backdrop of Sri Lanka, which is a very poor country, really, really needs food, and a rich country that's an extremely efficient producer and very cognizant and conscientious producer of food. And so you have two different stories, two different narratives that are basically really the result of, in my view, very narrow climate change policy. And I think it's reverberating. I think this will reverberate around the world. And it's something I would encourage everybody to not take my word for it. Go and look up sustainable farming Netherlands and try to read as many articles about that, because you'll see that these guys, again, I submit to you, they're not anti-climate change knuckle draggers. These people care about being efficient and producing high quality goods, and they pay a living wage, on and on and on. You guys have heard it. But anyway, that's what's going on in the Netherlands. I don't know if you guys have different questions or.
No, I mean, I think, like, again, guys, like, I think we just have to understand, like, I think it's just putting like your politics aside. It doesn't matter what you think. Like, if you are pro climate change or against it, or if you believe in it or don't believe in it, it's not really the point. The point is really just like, okay, let's understand, the economics behind it, and what does this mean for us living day to day? What does this mean for our wealth, our portfolios? I think that's really the biggest takeaway, and just understanding that, like, these policies, again, like, I don't think it's a surprise. I mean, like, for example, like these, the Dutch not being able to basically have like cattle. I mean, I think if you kind of like follow some of that side of politics, like, there's a huge cohort of society that doesn't want you to eat steak anymore. Like, how does that impact like your life, and then people starving and all this sort of stuff. So there's actually an update from in Canada here, on Canada, the Canadian government website says reducing emissions arising from the application of fertilizer in Canada's agricultural sector. The government of Canada announced its strengthened climate plan, and one of those ones is to reduce GHG emissions arising from fertilizer application by 30% below 2020 levels by 2030. So the same sort of thing here is kind of ongoing behind the scenes. That's going to impact, the farmers here and our food output. And there was actually an article that we shared. We've got a Loonie Hour group chat. Funny enough, it was actually removed. We knew it was going to get removed, but it was on the UN, United Nations website, talking about food shortages and.
Did it get removed?
I'm looking at it right now.
Amazing.
Got removed, but there's
it's not amazing. It's amazing it got posted in the first place.
It's amazing.
Steve,
go ahead.
Steve, why don't you explain what the article is in case people haven't?
It literally said that food shortages were a good thing. That was like literally, I think, like maybe not verbatim, but that was like the article headline. And so it got circulated around on Twitter. Like, I actually clicked on it. It went to the UN Nations website. It was like legit. It was on their website, and there's a bunch of screen grabs. So ultimately looks like it got taken down. But I'll just read you an excerpt from that article. It says, quote, "For those of us at the high end of the social ladder, ending hunger globally would be a disaster. If there were no hunger in the world, who would plow the fields? Who would harvest our vegetables? Who would work in the rendering plants? Who would clean our toilets? We would have to produce our own food and clean our own toilets. No wonder people at the high end are not rushing to solve the hunger problem. For many of us, hunger is not a problem, but an asset." So
That's just a lack of understanding about productivity growth. And I think it's not at all surprised that it comes from the UN. I mean, anyways, that's maybe the digression for a different day, but I think that that's an outrageous thing to say. And also a fundamental dislocation from reality. It is because people are well fed that we have Shakespeare. You say, Rich, how can you say that? It's because that there's an excess, a surplus of goods, a surplus of food, a surplus of all of these products. It allows societies to spend more time doing things that are not just trying to survive. And so not only is that an absolutely abhorrent statement, and that person should be summarily panned or put in the stocks or something and had vegetables thrown at them. It's just wrong. It's just not. Anybody who's spent any time understanding anthropology, even on a superficial level, understand that that's not true at all. So anyways.
it just kind of like, I kind of like poo-poo it because like I hate like the doomsdares, but it kind of makes you think like the whole like Klaus Schwab like 2030 great reset like stuff sound like less and less of like a conspiracy. Like you'll own nothing and you'll eat bugs. Like, yeah, it's kind of like, yeah. Like when you start like seeing like all these policies that are being enacted, you're like, oh God, like maybe these people that are talking about that, like, aren't that crazy after all. Like, is that the path that we're going down? Because, I'm just seeing it here in the political space, more and more talk about, energy policy, the energy policy that we're continuing to take. Like, I think we just have to understand, like, if these guys are serious about like, okay, this is the climate change path that we're going to go down and we aren't going to deviate from it, that like the transition away from fossil fuels to renewables, like it's going to take a lot of time and it's going to be very painful. It's going to be very inflationary.
People are going to die, Steve. People are going to die. People are going to, that's what it means. A lot of people are going to die. But I know some people will say, well, that's so, because Rich, I've actually chatted with the other side of this, and just agnostically, I'm just curious to hear like what their thought process is. I've chatted with the other side of this, and they believe, right or wrong, they believe that basically, if we don't go through this painful process, they believe basically people need to die and we need to depopulate in order to save the climate. It's already happening though. I've heard that before. Yeah, I
mean, they believe that it needs to depopulate rather significantly, and like people need to die in order to save like the world from basically going up in flames. So again, I don't know, right or wrong, that's what they believed. And so I think obviously we're saying, kind of the other side is, okay, well, listen, if you want to go there, that yeah, people will starve and die, and we'll have a lower standard of living because you'll have inflationary pressures, the cost of energy. So I mean, you can go back to Germany, right? Like they're basically having to start to make decisions potentially here in the very near future of like shutting down plants and conserving energy, and that's going to sort of decimate their manufacturing sector if that's the case.
There's one really important thing that I left out as far as the EU policy over the week, and then I'll kind of right back to Keith, which is the EU had a vote on whether or not natural gas, and nuclear power could be labeled, or the word is taxonomy. I don't know why they use that word, but as green energy, and it won. Greta was not happy, but yeah, so that's really, really important going forward, because they can now shift investment back into natural gas and nuclear. And just so everybody knows, natural gas is 60% less carbon emissions than coal, for example. Anyway, sorry, Keith, I know you want to say something.
So from our perspective, so this whole, just to bring it back to this narrative, we started talking about the Dutch and then the farmers, and then it moved over to the whole fertilizer space, stuff like that. Just from a pure investment perspective, it is what it is for us. We just see this as opportunity. So we want to be long agricultural commodities. And the reason for that, it's very likely, or the probability continues to increase, that the supply or the ability to produce increasingly more, buckets of food, it's not good. Okay, so it's going to decline, which means that there's an opportunity to make money in that space. So we want to be long in that space. And then on top of it, this whole, again, I keep going back to euro, and as everyone knows by now, like I don't have a very optimistic outlook for Europe. But with the protest that started in Holland this week, it's now spread to Italy this morning.
That's right.
It's also spreading to Poland. And I imagine by the weekend, the French will be joining it as well, because the French farmers are already up in arms anyway. Like they're already upset with government as well. So this has the opportunity to really escalate over the next few days. And remember, escalation means it's an exponential increase. It's not a linear, gradual every day. It's a little bit better or worse. So again, you go back to, okay, how does that affect global markets? It is going to affect the euro. At the same time, this morning, minutes came out from the last ECB meeting to suggest they're not quite as hawkish as what they were trying to communicate. And again, all these, everything is connected here. You're drawing one dot to the other, to the next, and you can clearly see where this stuff is going. So with Steve planning, a nice little romantic trip to Europe, maybe at some point soon, from a Canadian dollar perspective, it could be a lot cheaper coming up. But again, the cards are stacked against Europe right now, as well as you have to understand the impact it will have on the food and fertilizing industry. And these are all very powerful investment perspectives. So as Rich said, don't get caught up in the emotions of it. Don't, from your investment side, don't try to believe what is right and what is wrong, because there's no right or wrong in the investment world. It is what it is. And we just deal with it and move on. But again, this is a pretty big few days coming up over in Europe.
Yeah,
which leads us to the Brits. What's happening?
I'm just going to summarize just to bring it back to Canada here. I'm looking at a report on the food side. So again, keeping in mind all our farmers and whatnot. So it says here, just to quickly, I'll give you guys a quick summary. British Columbians paid 16% more for bacon in May compared to the same time last year. Other price grains included a 21% for cabbage and 28% more for chicken breasts. Albertans paid 14% more for chicken thighs, 18% more for stewing beef, 20% more for celery, 22% more for spaghetti. Shoppers in Saskatchewan paid 13% more for baked beans. Manitobans paid 18% more for apple juice, 23% more for iceberg lettuce, 34% more for mayonnaise. Ontarians paid 14% more for cabbage, 16% more for butter, 25% more for pork ribs. Quebec paid 16% more for white bread, 65% more for pork shoulder cuts. In New Brunswick, people paid 20% more for wheat flour. Nova Scotians paid 16% more for peppers, 17% more for baby food, 21% more for spaghetti. And I'll kind of just leave it there. I can kind of keep going on, but it was a nice report from Blacklocks there, just kind of highlighting a bunch of the food inflation. I think we've talked about the show ultimately, again, we'll switch gears here, but I think food inflation, I feel like food inflation in particular is the one where you start to get the social unrest. That's where the pitchforks come out.
So speaking of which, actually, it's something else I forgot. Sorry, I'm off today, I guess. But the one thing that's really important to note actually is, so I track something called the Goldman Sachs S&P Commodity Index, and they provide commodity price indexes, spot, so today basically, and total return indexes for virtually every single commodity that you could possibly think of, like literally every single. And the one that obviously the ones that I keep track of the most are oil, for obvious reasons, industrial metals, and agricultural goods. And, a couple of weeks ago, people were worried about the grain index, hitting all-time highs and continuing to rise. Well, actually, funnily enough, it turns out that, tanking your economy can impact the price of agricultural goods. And actually, oil's down 20% from the peak. Agricultural indexes, or the agricultural index, which includes grain and livestock, et cetera, is down about almost 27% from the peak. And metals, which is extremely sensitive to growth, especially in China, et cetera, is down 35% from the peak. So there has been some respite from the food inflation worries that we were talking about and thinking about several months ago. But I think the point remains. I mean, you need cheap energy in order to live the life that we all take sort of for granted. And I think we're being reminded of how important a lot of these decisions can be, and how often the people making these decisions, they don't have any skin in the game. They're not affected by it, you know? And I think that's for me, that's really important, especially from an economic standpoint. I mean, I don't know.
I mean, I was going to ask, actually, you kind of led me right into my next point, which was basically, how are you looking at this? Keith, you've talked about oil quite a bit. I know Rich has been super bullish. I mean, I think we've all been fairly bullish, but I know, Keith, you were kind of warning, a little bit that the trade might be overdone. What is this just basically? I mean, I'm curious your interpretation. I have my own interpretation, but basically markets appear to be sniffing out, the recent decline, for example, in energy prices. Everybody knows, like, structurally, I think, like, energy prices structurally should remain relatively elevated. And we do have an energy crisis, I think, that will probably be with us for at least a few years. But energy, despite that, markets, oil's been selling off. And is that just recession fears, Keith?
Yeah, that's what we suspect. So, anyone who's looking at as an opportunity to buy oil or energy, you might have that opportunity over the next few weeks, say 3 to 8 weeks, something like that. And then it could go higher again. So remember, nothing ever goes in a straight line. So longer term, I think the opportunity is pretty positive for that market. However, again, we keep going back. If the recession drums start to beat louder and louder, and it is confirmed by data, that will, overwhelm all these other stories we're talking about. And, that should create a correction, in some of the commodity spaces. So that's what we see as probably happening. And then, we would act on that. So that's the path that we're looking at.
So something on the oil thing, just really important, again, just to provide some context and some insight into sort of what sort of institutional investors might be looking at, is, again, oil prices that you see on CBC or at the pump. That's something called a spot price. Most commodities, I can't really think of a commodity that's not traded this way, is traded on a curve. So what does that mean? It means you are purchasing barrels or bushels or tons of whatever commodity out into the future. And so what I look like, not just me, obviously other more sophisticated investors will look at, is oil prices and the curve. So you've got a futures curve. So what you're buying, how much the barrel of oil costs to deliver today, in 6 months, in 12 months, and in 3 years or in 5 years. I don't think it goes out much further than that. Although in theory, I guess you could buy oil, and those commodities contracts are basically, they go out. And what's interesting for me is, 35 months out, I can't divide 35 by 12, but 35 months out, the decline has only been about, 6% or whatever. All right. And whereas the front end of the curve, which is much more sensitive to, obviously, different parts of, recession fears or whatever, is it has moved much more, right? So it's moved 20%, whereas far out the curve, it's moved maybe 5%. So it tells you the difference between sort of recession fears and then structural supply issues that might take longer to deal with.
Yeah, I
don't know. Sorry,
that's another
lesson there.
I guess we'll see how this shapes up. I always find it interesting, just to kind of summarize, is the goal of central bankers basically is to kill demand, aka induce a recession. But I don't think our sovereigns are set up for to handle recessions when global debt to GDP is at 365%. So either way, again, guys, I think this is just turbulent times. It's just kind of look out for yourself. Acknowledge the information that is coming in, that is hitting us here, and you try to keep your emotions out of it, and just accept that it is what it is. Governments and policymakers are going to make the decisions that they are going to make, and you just kind of have to trade around that and position accordingly.
Guys, speaking of I don't know, whatever word you just said reminded me of this, but guys, like today, the entire British Conservative cabinet resigned.
I know.
It's outstanding. understanding. I mean, like in general, every politician, the career ends in flames. That's just what happens usually, right? You just go out. But
Can you
today's
give us a backstory on that?
maybe I don't know much about it, but I think though, like from a higher level perspective, again, it's what we look at here is that the Brits, they are America's closest European ally. And when all of a sudden now you get complete confusion and chaos and all the stuff that Thomas the Tank Engine talks about, that creates this momentary pause in the geopolitical world. And it has huge implications with what the Russians are doing. They now have an open window to do a few things. And again, because everything moves in big waves all the time. Any government that's been in power for a while. So here in Canada, the red shirt guys have been in for a while now. It's inevitable that you're going to see that wave or that pendulum, swing the opposite direction as well. So people just need to get ready for that. But again, basically every conservative member in the British Parliament resigned today, including the Prime Minister, and a lot of reasons for it, but it's extremely dramatic. Rich, what's your favorite British show that you watch all the time?
Oh yeah, yes,
Do
Prime
they
Minister.
cover this? Yeah.
I mean, there's just a little bit of context. I know we're running out of time, but just a little bit of context with the British. So Boris Johnson is the Prime Minister, or actually, I still think he technically still is the Prime Minister until they find a new one. But he's been scandal-ridden for his entire tenure. He was scandal-ridden before he even got elected. So there's some corollaries there with somebody I can think of. But anyways, what I think is important to note is, I mean, I'm not even going to talk about his politics, just specifically about his tenure there, is that he's been caught in a couple of dumb lies. But for Canadians, I think what's really fascinating is the difference in power, relative power, that MPs have in the House of Commons versus the Prime Minister. And so this would be the second time in about 7 or 8 years where you would have had MPs basically circle the wagon, all staunch, like of a specific party. So MPs circle the wagon and boot the Prime Minister out of their position, but maintain the majority in the Parliament. And it's just sort of, it's, to me as a Canadian, it's a stark contrast with in Canada, where our Prime Minister sort of has for some reason, I think maybe it's a cultural thing, or I don't know, maybe a lack of intestinal fortitude, but money maybe, but they treat, whatever the PM in Canada, the Prime Minister says in Canada goes. And in the UK, it has a much, much more robust House of Commons, where you constantly see the Prime Minister held to account by his own peers who would abhor the Labour Party politics, which is the opposition party. And so they booted out Theresa May when she didn't deliver on Brexit, and yet maintained the majority in the House of Commons. And again, although it took a little while, they booted out their next leader, Boris Johnson. And so I just think it's, as Canadians, it's fascinating to contrast that, where leader of the party gets caught in a lie, repeatedly, lacks the confidence of the constituents. And in the UK, they're just like, oh, next one. And so now they'll have a leadership race within the Conservative Party caucus in the UK, and hopefully somebody will rise to the occasion.
Canadians are too polite.
Yeah, maybe. I don't know.
Hey, Steve,
we'll see.
You should be watching a movie be prepared for a movie this weekend, one with Vince Vaughn and Owen Wilson. Do you remember that one?
Big Crashers.
Yeah. Rich and I are coming, man. We're coming.
Yeah.
Come on down. Is there a direct flight from Halifax?
Oh, goodness. I lost my luggage on the way to Iceland, and it showed up the day before we left.
Oh, Jesus.
Oh,
well, it's a good place to wrap it up. As always, we appreciate the support. All we ask is that you share this episode with at least one friend or family member as we continue to build the Loonie Hour community one by one. As always, have a great week, and we'll see you next week.